Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time.
Hey everyone.
Hey guys.
Hope you guys are having a great week so far. This is the week of Christmas. We are excited around here. We got the tree up in the office. This is our Lunch and Learn session. Today we're going to be talking about the risks associated with buying bonds today in a low interest rate environment, something I think doesn't get enough attention. So we'll talk a little bit about that. This is our weekly 15-minute lunch and learn, a little food for thought, a little bread for the head. Today we will be covering the inverse relationship between bonds and or bond prices rather and interest rates. We'll also talk a little bit about what happens at the end of a 40-year bond bull market, which we've seen play out since 1980. How a 1% increase in interest rates could impact somebody's long-term to intermediate bond portfolio. And last but not least, how low interest rates are driving folks to take excessive risks. We're talking about default risk there. So that is what we are going to cover today.
Yeah, so why don't we jump right in, Mark? Let's go over how do interest rates impact the prices of bonds or other fixed income alternatives?
Okay, great question. So Troy, there's an inverse relationship, pardon me, between bond prices and interest rates. And one of the misconceptions that I see in our industry often, and there's some good reason for this misconception to exist, but if I were to say to you that there was an inverse correlation between bonds or fixed income and stocks or equities markets, you might agree with that, right? If stocks go down, bonds go up, and vice versa. And that's been a long-term belief.
Yep.
And the reality is that's not actually accurate. They happen to have played out that way over 40 years, but the real inverse relationship is actually interest rates and bond prices. Now, in the past, when the market got really volatile, oftentimes people would panic, sell out of the investments they're in, their equities investments, and we call it a flight to quality. They would sell out and go to the bond market. And when you have a huge demand for something, it can drive prices down, or in this case, drive interest rates down. And when interest rates were driven down on newly issued debt from corporate bonds, for example, or treasuries, prices would go up because there is an inverse relationship between prices of bonds and interest rates. So as interest rates fall, we would see bond prices go up, and as interest rates increase, we'll see bond prices fall. And that's really the risk of interest rate risk. Today, we're in such a very low interest rate environment that we're more likely to see interest rates rise in the future as opposed to continue to fall and continue to drive prices up. So if folks that today that are considering purchasing high-grade corporate bonds or even treasuries as a hedge against market risk in their portfolio really are now accepting pretty significant interest rate risk because we're likely to see interest rates rise in the future, particularly with some of the spending going on, government spending that can drive inflation in the future. And we might actually see interest rates rise. And when we see interest rates rise, currently issued debt will typically see a decrease in value.
What does happen when interest rates rise like that? So you said we're at a 40-year, basically a 40-year bull market.
Yeah.
With interest rates. What happens, or what's the biggest impact when those interest rates are at where we see them at today? They're low, probably the lowest we've seen them. What happens when they start to creep up?
Well, I think one of the best ways to talk this through is kind of let's say, for example, I have a portfolio that I've constructed for myself that I'm preparing for retirement. Okay. And I put some money in fixed income because I want to hedge against long-term or short-term market volatility. Right? So if the stock market gets volatile out and my investments in stocks drop in value, the equities positions that I hold actually lose value because the market's down. Kind of like back in March and April of 2020.
Right. Yep.
Okay. I don't want to sell those investments when the value of those investments has depreciated by 20, 25, or 30%. So I want to have some of my portfolio in a place, maybe cash or even fixed income traditionally would be a hedge against market risk. So I would have some money in bonds, right? So let's say today I'm constructing a portfolio and I go out and I buy treasuries and corporate bonds, and I'm able to get, let's say I'm able to get an average yield on that fixed income portion of my portfolio at 3%.
Yep.
Okay. And a year from now, interest rates rise. Okay. But now the market's volatile. I need to sell some of my investments, either equities or the fixed income, in order to free up cash to be able to maintain my lifestyle in retirement. So I don't want to sell out of the equities because I don't want to sell at a loss. So I'm going to go to my fixed income. I'm going to sell out of those. But if interest rates happen to rise, okay, and you as an investor can go out and get a fixed income portfolio of similar quality to mine that yields 4%.
Mm-hmm.
But I bought mine in a historically low interest rate environment, and mine only yields 3%. So I'm going to sell some of my fixed income investments to free up cash. Do you want to buy mine when they're yielding 3%, when you can go out and buy a portfolio of similar quality at 4%?
Right. No,
you don't want to. So if I want you to buy what I have, I'm going to have to sell it at a discount.
Right.
There is a capital loss. I'm going to have to sell at a loss just to free up the cash to allow me to maintain my lifestyle while my equities positions recover. And that's the big trouble I see with a situation where we have a really low interest rate environment. I mean, the 10-year treasury is below 1%, has been for a while now. We're seeing AAA corporate bonds hovering around 2%. So you might be able to build a portfolio without going into high risk junk bonds, somewhere maybe 2.5% to 3%. And then you're going to pay an advisor to manage that too. So you got their fees on top of that. It just, the risk reward profile is really sketchy.
Yeah, I think you said a good point there when you mentioned the junk bonds, because what we're seeing is people that want that interest rate, that 3%, we'll just use that as an example, to get that 3%. Now we're going out, we're taking on some corporate risk, credit rate risk, and we're going to these corporations that maybe aren't so stable, but we're taking a chance on them, buying those bonds, and they may or may not pay out that interest rate that we're looking for. We've seen that a lot with recently we looked at Puerto Rico. They were one of them where someone had some of that bond and it did not look like it was going to pay out.
Yeah, I've seen a couple of portfolios we have, in the last couple of years where folks own government debt.
Right.
In particular, one I like to pick on is Puerto Rican bonds. And they were yielding an attractive interest rate.
Oh yeah,
and
which they liked.
And it's a government entity, right? So the thought process there was, okay, that's probably pretty stable. Well, that general obligation bond or bonds from Puerto Rico went in default. This is back in 2016. Folks still haven't recovered their investments in there. They may get 50% of it out after the restructuring of that debt. Yeah. So it's really you're either going to go really high quality, like we're talking about U.S. Treasuries,
right?
Okay, and get very little yield, or you might go high grade corporate bonds. We call that high grade investment grade corporate bonds, and get somewhere around 2 to 2.5%, maybe 3%. And then if you want a higher yield than that, you're going to start creeping into we call the high yield market or the junk bond market, and you're taking on ever increasing default risk. Yeah. The fact that company may default on that debt, and that becomes an issue. So, one of the things that we've seen over an extended period of time is this just bull market in the bond market, where we've seen steadily decreasing interest rates for a very extended period of time. Troy, can you comment just on that a little bit?
Yeah. So, and you got the chart up there, Mark, but given what interest rates are today, over the last 40 years, we've seen that bull market in history creeping lower and lower. We're at a point today where, and you can see on the chart there, where we're at almost an all-time low, considering where we were at. So when we look at that, given where interest rates are today, do we think they're likely to fall or perhaps rise in the future? And that's the question we have to ask ourselves. When it's at the point that it's at today and it's that low, do we think it's going to go lower? or perhaps go higher.
Yeah, and I think it's fair to say that, after 40 years of steadily decreasing interest rates on fixed income assets, that we're in a position where it's more likely to reverse course and see interest rates rise than to continue to decrease, thus propping up prices further. And that's a risk we call interest rate risk. Right? That's another type of risk when you're dealing with income is interest rate risk. And I think one of the easiest ways to talk through that is just kind of talking about other fixed interest type of investments to help people get their heads around that. So let's say you go to the bank today and they're offering 1% on a CD, but that CD has a duration of 10 years. Are you going to buy that 1 year CD or that 10-year CD paying 1%?
No.
Okay, why not? What's your risk?
The risk is the interest rate risk. I'm assuming that interest rates are going to come up in the future.
And what? You're tied up.
And I'm going to be stuck in the
you're
1% for 10 years.
And you're going to have a penalty for getting out.
Right.
The penalty for getting out in fixed income often is you have to sell at a loss. You have to sell at a discount because nobody wants to buy your lower yielding debt.
Right.
When they can go out and
purchase something more that's yielding at a higher rate.
Correct. So that's interest rate risk. As interest rates rise, you could potentially have a depreciation in the asset that you own because of that.
Right.
And right now with the interest rate environment that we're in, taking any type of long-term position 5-10 years out, that could be really, really risky in terms of interest rate risk.
Yeah, absolutely.
Troy, the last thing I think we really want to touch on is just the impact that rising interest rates have. What does a 1% increase in interest rates actually do to a bond, an individual bond, or a portfolio of bonds? And
you have that on the chart there. It has a significant impact increase on the bond or on the interest rates. 1% has a huge bang on a bond portfolio. What does it have on? I can't quite see it.
So with typically, when we're talking about a bond portfolio, oftentimes there'll be an intermediate to long-term bond portfolio, somewhere between 6 to 10 years in duration. If you're going out longer than 10 years and really taking on some significant interest rate risk, but a lot of the bond funds that we see, the intermediate bond funds, they have a mix of different bond durations, somewhere between 6 to 10 years in duration. And a 1% lift in that could easily drop the value of that portfolio by anywhere from 7 to 9%. A 2% lift could drop us into double-digit territories if you were forced to sell out of that position to free up capital so that you could maintain your lifestyle. So there's a pretty significant risk associated with owning fixed income today. That doesn't mean that it's never okay to own fixed income. It does make sense for some folks' portfolios. I'm not throwing the baby out with the bathwater, but we have to talk about the fact that as interest rates fell over 40 years, a lot of the returns that were experienced by holding fixed income came from capital appreciation. As interest rates continuously fell, previously issued debt became more valuable because it was yielding a higher yield. Now we're kind of reversing that situation where you're buying fixed income at a very low interest rate with the risk that interest rates could rise. And we have to talk about interest rate risk. We have to talk about the fact that interest rates are very low today. So if I do want to go get a better yield on my fixed income, now I might start creeping into that lower quality, high yield marketplace, the junk bond marketplace, and taking on extra default risk just to get a little bit better yield. And I think a lot of folks are chasing yield today, either in the stock market, buying value stocks that pay a dividend, or by chasing high yield, the high yield bond market, just to get some income on their investments. And they're taking on some significant risk by doing so, that I think needs to be discussed before they jump in there.
Yeah, and I think that's a good point, because we're talking about risk. And we're talking about bonds in the same sentence. Where normally someone thinks of bond, I'm like, there's my safety. That's the safety part of my portfolio. It's a bond fund. And certainly I can't take a big loss on a bond fund.
And there is less volatility historically with owning fixed income or bonds, and that's why they've been used as a hedge against market risk. But they're not the only hedge against market risk. Yeah. And today there are significant risks associated with fixed income because of the environment we're in. It's historic. It's a historical place that we're in today, that we find ourselves in the fixed income marketplace. We have to address these risks. We have to be talking about them and weigh the risk to reward. And the risk to reward profile of owning fixed income in a portfolio today is not nearly as attractive as it has been in the past. In fact, it's kind of sometimes questionable. So really that's our show for this week. Hopefully you learned something about fixed income and the risks associated with owning fixed income, such as bonds in a portfolio. Next week, we're going to be talking about a very important topic, the widower penalty that happens when a married couple who's filing taxes jointly and one of them passes away and the other one finds themselves suddenly single in the late stages of retirement, and some of the increased surcharges and taxes that can hit that widow or widower at that point in time, and what you might be able to do today to start planning to avoid or at least mitigate that widow or widower's penalty. So we hope you join us. Hopefully you found some value. I'm your host, Mark Triplett.
Troy Westendorf.
Until next week, remember that every dollar has a purpose.
Every dollar has a timeline.
So go out and retire with purpose.
And retire on time. And guys, have a Merry Christmas. It's about 3 days away. If you're not ready, you got about 3 days to get ready. So you guys have a Merry Christmas, and we'll talk to you next week. Take care.
Bye, everyone.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.